ETF shorting. It's snowing, y'all. Take a look. We're going to see why you would short an ETF and how it lines up with our situation. So why would you short an ETF? Based on research, ETF short ratio is high. Now the short ratio is the short volume of short volume relative to non-short volume. That volume is high when the demand for shorting the underlying stocks is high, when the lending supply of underlying shares is low, and when the cost of shorting the underlying stocks is high. So all three of those apply in this particular situation. The only thing we don't know with 100% certainty is the lending supply of underlying shares. Now, ETF short selling is more active when the underlying stocks are less liquid or more volatile. These claims can be found in this reference here. I'll link this PowerPoint in the description below. Now, based on this paper here, if market participants are actively using ETF shorting as an avenue to circumvent shorting constraints, does ETF short selling have predictive power over the future return of the ETFs and their underlying stocks? The answer is yes. We find a significant predictive relation at the ETF level and an even stronger relation at the stock level. The higher the ETF short ratio, the lower the future ETF and stock returns. This is consistent with our understanding of why traders short ETFs. While some of the traders have bearish view on the ETF as a whole, many of them effectively use the ETF to short a subset of constituent stocks. A short position in the ETF and long positions in some constituents is equivalent to a synthetic short position in other constituent stocks of the ETF. Therefore, one would be able to more reliably glean information from ETF shorting activities by aggregating ETF short interests to the stock level. Stocks that lie in the intersection of several highly shorted ETFs are more likely to be the true targets of ETF short bets. Well, no shit. So some key points real quick. When we interact the ETF-based short ratio with variables that indicate tightening stock lending market conditions, we find the negative return predictability of the ETF-based short ratio is amplified within the group of stocks facing the most severe short sale constraints. ETFs allow arbitrageurs. No, don't worry. Arbitrage, all it means is the simultaneous buying and selling of securities, currency, or commodities in different markets or in derivative forms in order to take advantage of differing prices for the same asset. Now, it's funny because even the definition on Google in the example sentence, it says much of the short selling was being done by people who were arbitraging between the bond and the equity market, as an example. Now, arbitrageurs, ETFs allow them to establish synthetic short positions on stocks that are otherwise difficult to short. There you go. Now let's look at the ETFs themselves. Now, what you're seeing here on the screen is actually an example. It's sample data from a product that supposedly has securities lending data. We'll get to that at the end. Now, analyzing the ETFs with the most exposure to our stocks here. We have IJR with 3.9 million GameStop. This is short volume data as of August 2nd. Lowest we had was 36%, and that was shorted on the NYSE National, which only saw 7,300 volume. Everything else is above 60%. So we have IJR on the NYSE Amex shorted at 70% volume, 60% volume shorted on the ARCA, 64% shorted volume on the NYSE floor. Makes sense. No volume on the Chicago. Now for IWN, AMC, 4.4 million shares of AMC in this one. This one was 100% shorted. Granted, there was only 100 volume, but still 100% shorted. IWN on the NYSE floor, 46% shorted. IWN on the NYSE Amex, 90% shorted. 23% volume shorted on the NYSE National and 41% volume shorted on the NYSE ARCA. So obviously, one of two things is going on. Either there's very little shares to be able to lend in the securities lending market, which is what it's looking like, or the other thing they said. God dang it, what was it? When the cost is high. So obviously, GameStop to open a short position right now would cost them a little bit more. So, oh my God, I'm skipping ahead. What are you doing? Okay, moving on. IWM, the most manipulated ETF I've ever seen, has 9 million AMC, basically 0 from the Chicago, 43% from the Amex, 48% from the National, 30% from the NYSE Floor, and 43% from the NYSE Arca. So they're shorting the living hell out of these ETFs, and then on top of that, they're shorting the living hell out of the stocks as well. So check this out. Apparently, this is the only securities lending data I could find. I'm about to go ask my wife's boyfriend if I can get a month of this. Hey, babe, can you ask your boyfriend to buy this data lending stuff? She doesn't care. Anyways, yeah, look at that. It's only $2,500 a month. You thought Bloomberg was expensive, huh? It's about the same price, I think. Anyways, so now that we know that the ETFs are being, ever living shorted to hell, let's take a look at what the short volume was for AMC and GameStop last Monday or yesterday. What the hell? Where did there we go. Okay, so AMC was 40. So on top of that, so AMC's got 65.5% dark pool percentage, 41.1% short percentage, and then on top of that, you got the ETFs being shorted to hell as well. Perfect. Let's take a look at GameStop. GameStop. Gee, but wow, short percentage went down quite a bit. But again, if you look at this, they're shorting the ETFs. So dark pool percentage is down, short percentage is up. Dark percentage is down, short percentage goes slightly up. So as you can see, yeah, they're in a spot here. They're my titties are jacked. Anyways, talk to you guys later. Hopefully that helped. Basically, they're using arbitrage and securities lending and shorting. What else, right? That's what they always do. They're doing the same thing they've always done. They're shorting the living shit out of everything, basically. And we're done.